Hi, I'm Eric.
And I'm Dick. We are the Annuity Guys.
So Dick, fixed indexed annuities, and now we're going to talk about how they pay higher interest. And of course, the first thing we probably need to talk about here is higher interest than what?
Compared to what?
Yeah, what are we comparing here to?
Well, when you start talking about fixed indexed annuities, there's a lot of confusion and just a misunderstanding about them. They do historically earn more interest, and so they've become very popular as retirement products. But when we say they earn more interest, or like you say, compared to what? Yeah. Well, first of all, I like to think of banks because fixed annuities and fixed indexed annuities typically will outperform, banking products. And then if you're just looking at the annuity world, fixed annuities pay right now maybe between 2.5% to maybe a little over 3% would be, the going
Depends on
rate.
the commitment and the time period.
Right,
yeah.
exactly, with a guarantee. So if you compare them to that, you're typically going to get, maybe another somewhere between 1% up to 3% more. If you look at past historical averages, depending on the.
So you're trading a kind of a fixed guarantee
Yes.
for something that has the potential to give you more, but potential, not guaranteed.
Exactly.
So you're looking at kind of the historical averages when kind of making that statement.
Right. And Eric, one other one that we probably want to just mention anyway would be the variable annuity. If we compared it to the variable annuity and the differences there.
Right. So if you're looking at the fixed indexed annuity, and the reason it gets confused a lot of times, varying rates of interest. You don't have the same fixed rate every year.
Exactly.
And it's tied to a standard kind of market index.
Yes, a benchmark.
So you hear the S&P 500 now, you hear these other indexes, which makes people think, oh, it's in the market, but it's not.
It's not.
So a variable annuity is really going to be used with sub-accounts that are typically mutual funds or the like, and those mutual funds are truly in the market.
Yes,
so they have the fluctuations, the ups and downs. So you've got more unlimited upside on a variable annuity, but unfortunately you don't have that floor that you have in a fixed or a fixed indexed annuity.
Correct.
So it could potentially lose money.
That minimum guarantee is a big separating factor between the variable and the fixed indexed. And with the variable, you can actually go backwards with your principal based on market risk.
Right.
And with the fixed indexed annuity, based on market risk, you can really never go backwards.
Right. So Dick, you're a little bit older than me, so you probably remember when these things were created and kind of give us a little background on when the fixed indexed annuity
back
came.
when you were just a pup.
That's right. When I was a young'un.
No, since these have become so popular, Eric, as retirement products, a lot of folks are, have just heard about them, in recent years, but they really date back to like 1995. And this was when the mutual funds, were so strong, and the insurance companies were looking at mutual funds and going, hey, how can we compete with this, and get some of this action. So they came out with the fixed indexed annuity, and at the time they called them equity indexed annuities, and that was their direction. But that kind of quickly changed, where as they experimented with this concept, they realized that they could better compete with bonds and banks and give better interest, and that they were truly not an equity product. So they changed the name rapidly to fixed indexed annuity, and that's really kind of the basic history. They've been around for over 20 years.
Right. So now that you got a little bit of the history, let's tell you a little bit about how they work. How can an insurance company, let's talk about this in the sense of guaranteeing that you're not going to lose money, but still giving you some of this upside potential with this market performance, and how they do it without being in the market.
Yes.
And so you have to understand that they're not actually taking your dollars down and putting them in the index.
Right. They're not risking your money in a downside fashion where you could lose money.
Right. So you've got insurance companies that have these world-class money managers that are used to taking premium dollars from all sorts of different insurance pieces, investing it. Let's put they're investing it. They have their cost of operations, and then what's above and beyond their cost of operations is usually what they return to the policyholders.
Right.
So that 1.5% to 3% that Dick was referring to earlier, as far as that, we can give you this back as a fixed return.
Yes.
Well, what the indexed annuity is, it takes and says, all right, instead of giving you those dollars on a fixed return, let's give you an opportunity to leverage that dollar and perhaps earn more.
Right.
So they're taking what they would normally be giving to you in the sense of a fixed return, walking down to the kind of the options or the futures market, and basically putting a
Yes.
purchase in that says, hey, if this option or this piece comes in, you're going to leverage out and have a much higher growth
Right,
percentage.
right. Well, and the insurance companies, obviously, they are very good at managing risk. I mean, that is their number one mandate. And they want to make money, just like you want to make money. So when you put that combination together, world-class money managers, call options, which when they expire don't really cost anybody anything.
They're worthless. So there's nothing lost. There's no additional loss other than the cost of the option.
And so this is how, on a historic basis, they tend to achieve more interest. And it's a benchmark. It's just a solid benchmark that they use, and that's independent, and it's not somebody out there managing your money, so to speak, as much as it's just a benchmark that determines what your interest will be. And I think, well, Eric, you did a really nice infographic on this, which we can put on the page.
And make sure that
And but I think a real simple understanding of this would be kind of like you get a 3% guarantee, or you get your 3% put into the options call option market, and they manage it for you, and it hits, and you make more interest, and so you're going to have years, like you said, where maybe it's zero, but you're going to have other years where it's much higher, and that's going to give you a better average.
Right, and so that's what you're really looking at.
Right.
You're looking at to say, you know what, a zero is okay, because that means usually the market's down, or the index is down, rather. You would not have gained anything, even having been in the index.
Yes.
And what you're giving up is, you're giving up something on the upside.
Right.
In exchange for having that limited risk on the downside.
Yeah.
So,
well, and another thing that comes up often, when we're speaking with clients is, they're looking at that minimum guarantee. What I can achieve if the market isn't there, if it doesn't do good.
Yeah, zero doesn't sound great when you say that. Here's the guarantee. The guarantee is zero. It doesn't sound wonderful.
But on the other hand, getting a 1 or 2% guarantee, no matter what the market does, isn't necessarily the best choice, because it limits the options that the company can buy on your behalf. And so your average could be much lower in terms of your earnings potential for your interest that you're going to earn.
As we just kind of articulated, and taking your money down to the options. Well, if the insurance company has to reserve for a guarantee, and even if that guarantee is 1%, they can't take as much down to the options market and say,
your
all right,
potential is much less.
So we've got to hold these dollars back because we have more guarantees.
Exactly.
So the question is, sometimes more guarantees means less growth potential. So it's the balancing or the squeezing of the floor and the ceiling, and how you want to basically participate.
And this is kind of where we get into what's historical in fixed indexed annuities, and the Wharton study demonstrates that pretty well. It's an older study, but there's other studies out there that show that kind of on the low side, 3%, which is around the guarantee amount that you'd get on a guaranteed type, MIGA, multi-year guarantee annuity. But the upside is closer to 7%. And then, anecdotally, I mean, you'll see things all over the internet, which can be proven, where 1 year that, it makes 10%, or for a 4-year period it makes, 8 or 9%. But that's more of an anomaly. If you're looking at an average.
Well, and we have to put everything in perspective of our current rate environment. The rate environment right now is really squeezed down.
Yes,
and we
it
know
is.
that. We expect things to loosen up, and we expect these rates to continue to grow and have more upside potential. But
exactly.
So having something that has the better than bond opportunity, better than the bank, definitely, and just give you some of that upside potential for the long term.
Eric, one of the things I think folks have to think about is a fixed indexed annuity for me.
Right.
And I think some of the key questions that they need to really consider: can they live with fluctuation where their interest isn't going to be a guarantee every year? Can they take that zero for a couple of years and then enjoy the 8 or the 10 percent or the 7% that helps it to average out?
Right.
So I think that they have to determine if that's the camp they're in, or they really need that guarantee every year.
Right. Guarantees or potential.
Right.
You make the choice.
Yes.